Hello, ladies and gentlemen, and welcome back. In the previous video, we talked about the idea of buying the rumor and selling the facts. Now that we've seen the Microsoft earnings report, things are starting to become more clear. It was plus 4% initially upon the reaction of the report. It's the Q&A and, of course, the quarterly earnings forecasts that are suddenly changing it. The CFOs used a word that no one likes: deceleration. This is hitting cryptos, stocks, and commodities right now. Let's discuss them all together and look underneath the hood of what just happened. Well, welcome back, everybody, to The Daily Show, where we talk about the biggest news, the macro data, the lead indicators, and of course, the key levels that you should be watching. We're covering every market today, so stick around as we go through everything. Microsoft stock turns negative after being super positive as the forecast misses. The CFO warns about deceleration and, of course, some projections that are quite a lot lower. In fact, Microsoft suggested that sales in the current quarter will come in at least $1 billion lower than Wall Street's expectations. This is a big deal. Now, markets didn't like it. Did we tweet about it? Absolutely. Come over to @FXEvolution, links in the description down below. The Linktree link is probably the best, and follow us along with that. We've got some updates here to a few charts that might find interesting. We've been talking about smart money versus dumb money inflows recently. Smart money's been doing relatively nothing. They've been basically just buying at the same rate, while dumb money, we technically have been purchasing at out of control rates. Now, when we look at some stocks later on, you're going to see so many stocks hitting resistances. And we warned on this on the channel in the previous 24 hours. Apple, Nvidia, Google, Shop, so many stocks hitting all these key zones. Dumb money lapping it up. Unfortunately, the FOMO and the hype have been taking over, and this is one of those critical times where you have to be able to step back and have the temperament to not get involved or to potentially think about scaling like the big players do. Here's a quick snapshot of Shop over the last 24 hours of trade, just so I can show everybody what's happening. Generally speaking, this would be considered, of course, an inverse head and shoulders. Great looking trade, yeah? Well, the problem is that when it broke during the session, notice what happened: instant rejection. This is the type of thing that you see when you gain liquidity traps, and of course, Wall Street's pushing a certain narrative to then trap retail traders in. Doesn't mean it's the end and the whole thing's going to go down. Well, we'll look at that later on in today's video, but certainly Shop it showed some of those kind of problems there. We also had some rotation that was a little bit interesting over the last 24 hours. For the first time in literally 2 or 3 weeks, we had things like utilities and staples in the top kind of 5 investments for the session. That meant that Wall Street was starting to tighten up and they were rotating into defensives ahead of the Microsoft earnings call. What about fear and greed index? Well, we know that we've been watching this recently, and realistically, the market's been going back to greed. Now, if we think about only a month ago, we were in fear. So we've gone from fear to heavy greed very quickly. It's a symptom of things that happen when you've got like huge runs. And of course, you know, there's a lot of FOMO that can come into the market. It's amazing how with the click of a finger, things can switch quite quickly. Now, stocks are in a very, very big and dicey predicament. We know that if we get the trifecta, that is the Santa Claus rally, first 5 days positive, January return being positive, and we had a negative year, 100% of the time, at least in our recorded history we have here, we have a positive market for basically 2023 in this case. Now, we don't know what January is going to do, but we also do know we only have a few more trading days left. So watch this chart. We're doing it. We're continuing to follow that story as quickly as we can. As we mentioned before, we have things like utilities and staples coming in. This is only the first day of rotation, but certainly something we are watching. And if you look at it over the 5 days, of course, semiconductors, communications, technology, materials, consumer discretionary, these were the most popular, and they were the ones that, of course, retail was jumping all over. As we mentioned, this week has almost 20% of the S&P 500 doing its return. We've just seen Microsoft. It wasn't pretty, at least the initial reaction. We'll see how the market ends up opening up and, of course, making the next moves. But we do have Tesla coming up Wednesday after the close. This is an exciting week, but also one that we need to be prepared for. Just before we jump into the charts, we take a look at all the key levels that you need to be watching in the markets right now. I did want to thank the sponsor of today's video, which is of course Tiger Brokers. They're running a special promotion for so many people around the world right now. And anybody that's entering during the Chinese New Year celebrations and opening an account, funding it with as little as 1 cent, will go in the prize draw as well to win one of our packages, and that's for our courses as well. We've teamed up with them and we've given away one of each of our courses. So take a look at the description if you're interested, and of course, potentially look at opening up a Tiger Brokers account. Why is it important to have a broker like Tiger Brokers? Well, you can see here, I'm loving what they're doing here with improving their platform. Tesla's earnings call, you can watch the live stream within the platform. I love that type of thing. At the same time, there's a whole bunch of news coming through. They do have premium headlines. So remember, Reuters, Bloomberg, and Seeking Alpha, all these other ones here, you're getting all of the news in your feed instantaneously. This is the type of thing you need during earnings season, along with a market calendar and sector rotation. Make sure you consider checking out Tiger Brokers in the links down in the description down below and taking maybe the opportunity to get some of their special offers. All right, well, let's jump into the charts and take a look at it. First up, VIX sitting around 19.19. Nothing much to note about this. Of course, anywhere between 18 to 20 historically has been usually a time to trim positions over the last year and a time to be cautious in markets. Well, we're at that point again. So, of course, we're expecting hopefully a VIX rise. Usually Q1 is when VIX rises and Q3. So they're the two big ones where you see VIX spiking up. If we take a look now at the big thing here, which is, of course, the US 2-year, you can see 1, 2, 3. That is 3 days up, 1 day down now in terms of yields. We're seeing yields actually go up as the stock market was going up. Something that reminisces of some of the bull market fake rallies that happened in 2022. It's nowhere near as significant in terms of moves, but interesting nonetheless. If we have a look at TLT, had some decent inflows. It still looks like it's in a bit of a chop. Obviously, we had that reversal island up here, so TLT could still move down to 102. I expect it to sit in this zone for a little while, and then hopefully we get a breakout. We're still positive on TLT for 2023, but it's not so much a trade. It's more of one of those investment kind of products. And that's the thing with bonds. They've become trades recently, but that's an unusual thing. They don't tend to do that as much. Let's move over to the US dollar. So the US dollar continues to bewilder most people. And I think it's still at a very critical zone, but we don't have clear direction yet. We've got a lot of long leg dojis, a lot of rejection wicks, both for the bullish and bearish side. And at this point, every time it rallies, it tends to get shorted. And every time it comes down to these 101 kind of 29 to 101.50 zones, it tends to be bought. US dollar could certainly spike up here. Sentiment's been very negative on it recently. If the stock markets do end up failing here, of course, the US dollar could be part of the trade. They're not as connected as they once were, but this is a key zone. We're not, again, seeing too much action here. Until we really break that 102.35, we're not prepared to say, okay, this thing is bullish, nor is it bearish. Be nimble, be fast in some of the trades. If you take a look at the euro US dollar over the last couple of hours, you'll notice here it's just basically again stuck within a zone. If we do break out to the 109, that possibly could begin some further rallies and maybe pullbacks will be met by bull demand. It's at a critical zone though, right on supply. Be very, very careful here with these pairs. Look at the supply, look at the rejection. This is where I would think bigger players would be trimming their position and waiting for the next big bit of news. Let's move over to US oil and have a quick look at the oil barons out there. We're not seeing a breakout past these high wicks yet. So we will set an alert just in case we get past 83 in the future. I probably have taken a little bit more of a bullish stance on oil recently since we got through 77. I guess I still maintain that. I'm looking for further bullish breakouts though to push those 89 and 92 narratives. So we'll keep coming back to this chart as we see more information. Let's move over to the metals. So copper has been the discussion, or at least the China reopening story. We see copper still at our golden pocket. So coming into Chinese New Year, we tend to have that run in metals and materials. We find ourselves exactly at that zone right now. If we move over to something like gold and we scroll down to the 2 hours here, you'll notice that with gold, it's realistically been hitting a lot of the previous kind of wicks and finding buyers. It hasn't tipped over yet. So each time gold has basically come back to these wicks, and you can see what happens, it's finding those buyers. So for now, gold's still in an uptrend. We'll come back to it and check it out in the future. Another thing that might be worth watching is just like a trend line that's sitting behind for gold recently. You can see here the touches, 1, 2, 3, 4. It's dulling, that is, it's slowing down in each one of its hikes, but it hasn't shown a change of trend just yet. So it's still bullish until proven otherwise on this chart. Let's move over to Tesla. So this is sitting in the middle. We do have the expected options for the week close. So that is 68% of the time, Tesla will generally hold between these two zones. Now, noticeably, we're sitting around 144. I can tell you there's a decent amount of 150 calls in this week for Tesla. It's not huge, but let's have a look at it together now. So there's the 150 calls, clearly the biggest option strike. Now that kind of gives bulls their target zones. 150 to 155, 160 is probably on the top end after any type of earnings. And from the bottom end, of course, you did never expect it to get underneath 100. Now, where are some of the key zones though? It seems to be between 120 and 130. The puts could enlarge here coming into earnings, especially considering we're now selling off in the futures action. So people may go bearish on the session. And somewhere between that 130, kind of 145, 150 is where I expect the market to be. If we go back to the chart just quickly and have a look at it, you'll notice that we have that 132 expected weekly options low. You can use these kind of like a partial support. So if the market comes down to this area, remember the market was expected to hold within the zone 68% of the time. So it's actually better than probably some people's out there's trading statistics. Although we're holding in a range, that's what the options market expects. So as it pulls down through that, you're actually filling a gap in here as well. There's a chance that somewhere around there you may find some buyers. It's all in earnings though. There's not much you can really do at this stage. It's in the hands of what the market's expectations are. Speaking of market expectations, we did say buy the rumor, sell the facts. So far, so good, I guess, for that. The main reason, just look at this. We've got some evidence here that looks ridiculous on paper. Apple's downward trend line, Apple's fill of a gap. Both were reached, both, of course, tested. Then we move over to Exhibit B, NVIDIA. Inverse head and shoulders. I think anyone can see this. You could get somebody with probably 5 minutes of technical analysis experience, and they're going to say inverse head and shoulders. Everyone's watching it. Downward trend line, inverse head and shoulders, resistance. Even the proofing of the head and shoulders was proofing to the top again. So very, very critical point. Google's downward trend line. Again, I put this over on our Twitter. Definitely follow it. 3 days, 10%. Everyone's hyped on AI. You can see the rejection coming through there. It's just a very critical zone, so you can see how it's so important. Here is Microsoft. Now, it was up, remember, plus 4%. Now, look at it, 240. Down only a little bit, down 0.55%, but that's a huge switch. Plus 4 to down. So big stock, big trend line. We haven't broken anywhere near the lows here, but obviously something that we will be looking at. And Microsoft actually showed weaker than you would expect into it. Now, part of the reason is, even though this is my favorite stock in the market, I've talked about it many, many times. I love it for many, many plays, and it's just a well-diversified stock. It's not cheap. It's actually one of the most expensive stocks in the market at the moment. It's held up really well, but part of the reason it's holding up well is because a lot of big players, they want to hold that stock. They know that it's really, really solid. Another one I want to bring up just again is just SHOP, and I'm just going to put it in the charts right now. Let's bring that on. There's the breakout. You can see again, inverse head and shoulders, what it looks like. Here's the breakout. It ended up just instantly rejecting that. Another potential trap here on the markets. Got to be very careful. If we end up breaching these and closing though, well, you've got to start saying, okay, it looks like we're going towards the next rally points. Let's speak about the indices now. Let's have a look at all of these key levels. So 1900 on the US 2000, the previous daily high, and also in between this very tight zone that's shown so much selling in the past. We're still there. We're not going through yet. So we can't really be fully bullish on this market. Although everyone said the trend line's broken on the S&P, we haven't seen the Russell here break through correctly. Let's have a look at the NASDAQ. So the NASDAQ took a new high. You'll notice it took a new high.